Thank you all very much for joining us today. Thanks in particular to my colleagues from Hans Helmet on through, who put themselves on the line in public to defend Brazilian honor and seriously engage with us. Joking aside, as Lucio said at the start of today, we've had a very fruitful collaboration between Moody's Investor Services and Peter's Institute, and I want to thank Dietmar and Alistair, and especially Lucio, our colleagues from the Sovereign Risk Group, who've been wonderful hosts and collaborators today. You all heard all the talk. Let me just try to drive home 3 or 4 quick points. We motivated this conference, and we got many of you to show up, despite the fact that the ECB, rightly, I think, took the step towards quantitative easing last meeting. And this is because intellectually, particularly here in Frankfurt, as was indicated by the last question, this was not a foregone conclusion. And our hope today, at least I think what Lucio and I had in mind, was to bring a thorough, practical, well-grounded, leaving me aside, set of discussions to Frankfurt to engage with this alternative narrative and alternative framework that Hans Helmut, among others, tried to explain today. And I'd like to think that we've done that. It may or may not have engaged directly with the people who are advertising or advocating that narrative. It certainly was not intended to be conflictual, but I do think it was important that all of you in this room are able to go out and, whether you agree or not, have been stimulated by, I think, in full form, a good version of that narrative. And the second point I want to say about that is, I think it is a narrative that we can leave aside some of the rhetorical flourishes that our friends from Greece are employing at the moment. It is a narrative that is based on sensible economics. And it's not a narrative of just us Anglo-Saxon Keynes-worshipping doves of the world, for want of a better term. It is the workaday narrative of practicing central bankers, formerly practicing central bankers, people who are consciously trying to do the right thing in a relatively technocratic way. Doesn't mean it's right necessarily, but it means it's not being driven by some conspiracy, it's not being driven by some Anglo-Saxon fantasy, it's not being driven by desire to bankrupt everyone else so Greeks can work no hours. It is mainstream economics practice. Third point, and this in particular draws on, of course, our keynotes by Eric Rosengren and Peter Pratt, but I think everyone today contributed to this discussion, is the sense that central banks have to do their job. And after many years and many decades of struggle, all the major central banks, including the ECB, but also the Fed, the Bank of England, the Bank of Japan, the Swiss National Bank, and so weiter and so forth, have roughly the same mandate. And the mandate is, Eric importantly emphasized the differences between the US mandate and the ECB mandate. Angel has made a proposal for a meaningful change to the mandate. But broadly, it is about stabilizing nominal growth over the cycle and doing so in a way that doesn't cause financial disruption. And I think we all can agree on that. And so once you say that, then we get into the kind of syllogism that Peter was talking about earlier today, the kind of democratic role that Paul Tucker was trying to expand on theoretically, the kind of talk that Eric Rosengren was having that I think most of us share, which is if you're going down a deflationary path, stop worrying about what everyone else is doing, use the tools you have at your disposal, and try and fix that. And to the degree we can commend our friends and colleagues at the ECB, including some people of Germanic descent on the Governing Council who voted for QE, it is because they're doing their job. And what I hope we did today is help you think about the best ways to do that job, the state of the art to doing that job, and the reasons why they're doing perhaps not God's work, but good policy by trying to do that job. So thank you very much for joining us. We look forward to seeing you again, perhaps here in Frankfurt, if Dietmar will have us back, at future Moody's and Peterson joint events. And thank you especially to our speakers who made the effort to join us today. Thank you very much.